Welcome back to another episode of Tax Flow to Cash Flow, where strategy meets legacy and your money finally starts working for your family and not just through you. I'm your host, Denise Givan, the Tax Strategist, and today we're going deep into a topic that most business owners avoid, delay, or don't even know how to start: family succession planning, and why it's not just an estate conversation. It's a tax strategy. If you're building a business, a brand, or even managing multiple income streams, and you haven't planned for what happens when you step away or pass away, you're putting your family at risk and leaving money on the table. Let's fix that today. What is a family succession plan? Let's define it. A family succession plan is a structured, intentional strategy for transferring leadership, ownership, and operations of your business or assets to the next generation without losing momentum, money, or mission. It's not just a will, it's not just a conversation over dinner, and it's not just for old people. It includes leadership transitions, ownership reconstructing, tax planning, entity documents, training the next generation, and legal tools like trust, buy-sell agreements, and management companies. And when done correctly, it can eliminate estate tax liability, prevent court battles, and protect your wealth from dying with you. Now, why succession planning is a tax strategy? Let's be clear. Succession is not just sentimental, it's financial. Here's how it connects to tax strategy. Avoiding estate taxes. If you die with a high value business or portfolio and no plan, the IRS can tax up to 40% of your estate. Now, number 2, set up basics. With proper planning, your heirs can inherit assets with reduced capital gains exposure. And number 3, trust-based asset transfers. Assets held in a trust can avoid probate, reduce estate value, and pass directly to beneficiaries. Number 4, gift shares strategically. You can give shares or ownership gradually, taking advantage of annual gift exclusions and reducing tax liability over time. Number 5, salary and compensation planning. Succession can include paying heirs as employees, contractors, or partners, creating legal deductions for you and income for them. If you wait until you're ready to retire, you already lost control of the tax gain. What should be in your succession plan? Here's a high-level checklist. Now, the successor's identification, who's stepping in, a child, a partner, a CEO, ownership transition plan. Is equity being transferred through gifting, sale, or trust over time, or all at once? Now, I'm going to repeat that. It says ownership transition plan. Is equity being transferred through gifting, sale, or trust over time, or all at once? These are things you got to know. Legal structure review. Do your LLCs, S Corps, and trusts reflect the transition? Tax tax analysis. How much tax exposure is created by the transaction? And how are you minimizing it? Training and communication. Is your successor ready? Have you documented processes? Is the team on board? Estate integration. Is your business covered in your estate plan? Do your will, trust, and life insurance align with the plan? Now, having meaningful family conversations. Let's pause on the tax talk for a second and talk about legacy leadership. You cannot pass on what you're not talking about. Most succession plans fail because the next generation is unaware, unprepared, and most importantly, uninterested. You must have conversations like, what role do you want in this business? What do you see for your financial future? Are you open to co-owning assets or taking over one day? Do you want training now or later? This isn't just a financial transition. It's a mindset handover. Structures that support smooth successions. Let's talk tools. If you're serious about succession, you need to consider revocable living trust, owns your assets while you're alive, passes them automatically when you're gone. Family management companies allows you to centralize control and distribute income to family members legally. Buy-sell agreements. If you have partners, this agreement protects the business if someone dies or exits. Grantor retained annuity trust, a way to transfer wealth while freezing asset value and minimizing tax exposure. Family office infrastructure. Manage family wealth, taxes, legal, and advisory as one integrated operation. So let's talk about some real world strategies and examples. So here's a story. A real estate developer created a family trust and transferred 6 properties into it. Over 10 years, his kids became co-trustees. He reduced estate tax exposure from $1.3 million to $150K and still received passive income until he retired. Wow. Let's talk about this story number 2. A coaching business owner licensed her content to a new IP Holding LLC owned by her son. He took over marketing and delivery. The licensing income was deductible to her business and now builds his retirement fund. Wow. A retired doctor sold his practice over 3 years to his daughter using a structured installment sale. He spread the tax hit, stayed involved part-time, and mentioned her through the process. Now let's recap. Family succession planning is about more than death. It's about control, continuity, and cash flow. The IRS will take what you don't plan for. With the right tools, trust, LLCs, IP planning, and tax strategy, you can hand off wealth, not a burden. Most importantly, have the conversations. Don't wait, don't assume, and don't hope. Want help building your custom succession strategy? Book a private session with me or download the free Tax to Cash Family Business Toolkit. It's your first step toward real legacy planning. I'm Denise Givan, the Tax Strategist, and this is Tax Flow to Cash Flow. Share this episode, leave a review, and start the conversation in your family today. See you on the next episode.